Hey, this is Nick from Income Digs, and I'm so glad you're here for this course on QuickBooks Online, specifically for real estate investors and their bookkeepers. So if you are an investor yourself, or you're a bookkeeper working with investors and builders, you're gonna wanna take in this entire course. We're gonna follow up on Module 1 with Module 2 today. Now this course, I'm gonna go pretty much end to end through my entire system. However, if you want to go more in depth with some help from me, with some community help from me, check out our course, Real Estate Accounting Bootcamp. But let's get into today's module where we're gonna talk specifically about purchasing property. Now this should be something that's relevant to everybody, whether you flip properties, long-term rentals, short-term rentals, whatever the case is. Understanding how to record the purchase of property and the various different aspects that go into that is absolutely essential. It's foundational. Let's make sure we get it right. But we're gonna talk about in this specific module, 3 keys to recording the purchase. First, understanding journal entries. Journal entries can be a little bit intimidating. I'll admit that. They were for me as well, but we need to understand them and we need to embrace them because they're an essential part of our setup here. Follow the HUD. So we're going to get a HUD statement, a closing statement on pretty much every single property we ever purchase. We want to use that and we want to really just mirror that over to QuickBooks. Understand the difference between an asset or cost of goods sold. We're going to discuss how, depending on the type of property that you're investing in, we might put things on our balance sheet, which it would be an asset, or as an expense, cost of goods sold, and potentially move things around between them. All right, so those are the 3 things we're gonna focus on. Let's talk about journal entries. Now, here's a little secret. Every single transaction in QuickBooks is a journal entry, which might seem a little crazy. I'll show you in a second how we have all these different transaction types, right? We have expenses and sales receipts and all that. Every single transaction that actually goes onto our books is, behind the scenes in the background, a journal entry. And what QuickBooks is so good at is giving us these kind of shortcuts. That's what these other transaction types are. But again, in the background, they are creating a journal entry. I'll show you exactly what I mean by that. And that should help us to not be so intimidated by them. Every single transaction is of this sort, so we can use the journal entry transaction to get what we need as well. Understanding that, we need to know that there are 2 sides to every transaction, okay? Which really makes a lot of sense when we see what a journal entry looks like. We have debits and credits. We have 2 sides. On those transactions, it's very obvious. Behind the scenes, QuickBooks is doing that on the other transactions as well. Every other transaction is really just a shortcut, okay? So an expense is a shortcut to a journal entry. A sales receipt is a shortcut to a journal entry. We should always use journal entries for complex and or important transactions. So don't just go to the bank feed and see you had cash at closing for a sale or you had cash that came out of your bank account for a purchase and just record it right there. We want to first go and create the journal entry because there's so many details we have to ensure that we capture. Now here's some debit and credit rules. One of the most confusing things about journal entries is you have these 2 columns. You have debits and credits, and knowing where to put your various figures is really confusing sometimes. So this chart, if you want to screenshot this and just save it, put it on your desk or put it on your screen somewhere, it's going to be really helpful to you. Now, I've created some shortcuts in my mind to kind of memorize this stuff, but sometimes here and there I got to refer to this chart. Basically, we have our 5 different account types, right? We talked about those during our last module. First 2 show up here are profit and loss, income or expenses and cost of goods sold. So income, anytime we want to increase that, we're going to use the credit column. Anytime we want to decrease that, we're going to use the debit column. And then the reverse of that is true for expenses and cost of goods sold. To increase it, we use debit. To decrease it, we use credit. The next 3 are all balance sheet accounts: equity, asset, and liability. For equity, to decrease it, we debit. To increase it, we credit. Assets, opposite. To increase it, we debit. To decrease it, we credit. And liabilities is the same as equity. All right, so I don't expect you to memorize that. There's an open book test. You might as well save this for later. I'm gonna show you how we're gonna use this as we get into our journal entries in QuickBooks. Back over to QuickBooks, let's look at our chart of accounts and understand how these journal entries work. Now, as a reminder, we looked at our chart of accounts during the last module. We're going to be using a generic account setup here, something like this, where if I'm recording the purchase of property, I will want to have already set up a few of these accounts. So real estate owned, that's kind of my parent account. That have very generic accounts here for land, building, closing costs, CapEx. Furniture I won't really use, that would be a short-term rental type thing, and depreciation. We separate these out because they're going to depreciate at different schedules. We certainly want land separated out. Building, closing costs, CapEx, that makes sense as well. Furniture, you can decide whether you want that or not. That could maybe be a sub-account of CapEx. But either way, we need to have those accounts ready to go. And they are. Let's look at what a journal entry is, okay? Now, to kind of demonstrate this, I'm just gonna go to my reports. I have balance sheet as of 2018. There's not much going on here at all. I'm just gonna create a journal entry. I'm going to use the rules that we talked about, all right? I'm gonna do this as of 2018 just so it shows up back there, okay? So let's say that I wanna record an expense on my books, okay? So I can pick an expense account here. So that could be something like repairs and maintenance, right? There's repairs and maintenance, cost of goods sold. Cost of goods sold and expenses as far as journal entries go are the exact same type of thing. They both are negatives to your P&L. So if I want to increase this expense, meaning I want to incur that expense, I want it to be greater than 0, I'm going to debit it. Right, we had seen that in our chart there. So if I had a $150 repair charge, I'm going to debit it right there. In my description, I could potentially say repair toilet. All right, and we could also put in our class there for the property. We're going to get into business tracking later in this course. I'm not going to fill that out right now. All right, so repairs and maintenance is my one account. What's the other side of the transaction? I've incurred the transaction. I've incurred the expense. It's going to show up in my P&L. QuickBooks wants to know, where did the money come from? Right? That's what it's asking here. What's the other side of this transaction? I cannot simply click save and close. QuickBooks won't allow me to. It needs debits and credits to equal each other. And this is ultimately what we're paying for when it comes to QuickBooks, okay? So we're paying for this check to ensure that we are not having debits and credits not equal each other. It's requiring me to add something else here. And so I'm going to indicate here, which account did I use to pay for this? So this could be a credit card, this could be a bank account. I've got a bank account right here, JMB checking, I'm gonna use that. Now, a really neat thing about the way that QuickBooks is set up is if we just have a 2-line transaction, it's usually going to guess correctly that, hey, if I have 150 in debits here, that means I have 150 in credits on this side. So rarely do we have to memorize both sides of the transactions that, hey, repairs and maintenance goes up, that's a debit. My checking account goes down, that's a credit. I don't really need to memorize that. I kind of just need to have one side of the transaction. All right, I'm gonna save and close this transaction right there. All right, and that has decreased my checking account and decreased my net income as well. If I drill down into my net income, we will see that repairs and maintenance, I have some other stuff in there. Let me just see if I can find that exact transaction. There it is, that $150 journal entry. Now here I have some expenses. And what's really cool about this is these expense types show up in the same place. And I want to show you what I mean by there's two sides to every transaction. A huge benefit of using the expense here or adding something from your bank feed is it's quicker. It's an easier dialogue. I don't need to memorize debits and credits. It's easier for me to understand, this is the account I paid from. This is the category for which the expense was incurred. And it's just easy, okay? And we should use that for sure. We should not use journal entries like I just demonstrated there for simple repairs and maintenance. I just wanted to do that to drive home the point. But I do want to use this exact transaction where you can see I have two splits here. If I go into QuickBooks and go to more and then go to transaction journal, what this shows is actually how QuickBooks took that expense transaction and made a journal entry. So here's my date. It took the business Visa account, which is what it came from, the credit card it came from. It credited that account $9,000 and then it debited my 2 expense accounts. This is exactly what I mean by every single transaction is a journal entry. In this case, it's a 3-line transaction. I have 1 line for the credit card and then 2 lines for the expenses. All right, and QuickBooks is doing all that work in the background. It's great. But sometimes we need to do journal entries ourselves, which is what I'm going to demonstrate as we get into actually recording the purchase of property. All right, so we understand what a journal entry is, debits and credits, and as we go through the examples, we're going to really drive that home. All right, so most HUDs do the work for us. So a HUD, right? This is a closing statement. We should typically get a closing statement with every single purchase we make. If you're not getting one, insist that you do. From your closing attorney, from your title agent, whoever it is, we need to make sure we have a really detailed and accurate HUD so that we can record the purchase properly. Follow the buyer side, right? We're going to be demonstrating buying property right now, not selling. We can almost ignore the selling side. We can look at it a little bit, but really, for our concern, it's the buying side. We're going to use debits and credits. We're going to check our work along with the HUD. Save often. This is a little trick I'll show you. All right. And then cash to a closing is our final check. This is our aha moment. Did we do it right? To demonstrate this, I'm going to bring up a HUD statement for a simple cash purchase. Okay. So here's my HUD statement. And again, we're just looking at the buying side of this transaction here. So here I have my purchase price. I've got settlement charges. Then we have a bunch of stuff that were paid by the seller in advance, meaning I owe this back to the seller. Okay. So these are some items that are increasing the amount that I owe on this property. Not only do I owe the sales price, I owe all these settlement charges as well as these other items here. So that gives me that $662. Now I also have some stuff going in my credit, meaning I have a deposit that I've already submitted and I have some taxes and some security deposits that the seller actually owes me. All right. Now usually on the second line of this, we have the detail of that $6,400. So usually that closing cost situation is detailed out on that second page. Really, really useful. Now, before we add the journal entry, let's go and think about things in truth. And what I always say is when we're adding a transaction in QuickBooks, let's kind of tell the truth from a historical timeline perspective. And the first thing that typically happens, the first transaction that we incur when we're buying property is almost always a deposit. So we're almost always submitting a check and saying, I want to buy your property. We're going to work through the details, let the lawyers, let the closing attorneys figure it out. But right now, $5,000, $10,000, whatever it is, I want this to go down into an earnest money account so that we can establish escrow and we know that we're going to move forward with the deal. That transaction, that check usually gets cashed. So what do we do with it when it gets cashed? That is something where we take in an account called purchase deposits or purchase escrow. Okay, so this should be in our chart of accounts. This is an other asset. So something like purchase deposits right there. Okay, that would be an example. So let's go to my balance sheet as of 2018 again, and I'm going to create that purchase deposit. Okay, so when that comes through, that can come through from the checking account, from the bank feed. I could do a journal entry. In this case, it could just be an expense. Okay, so who did I pay? I don't really know right now. Let me just pull up my bank account. It came from this account. It was on this date, and my category is purchase deposit. So as soon as I record this transaction, $20,000, whoops, not 200,000. What should happen, two things. One is my bank account should go down by $20,000, right? They cashed the check. The other thing is that on my balance sheet, I should see a positive $20,000 showing up in my account right here, which is really important because when we indicate this exact thing on our HUD, we're going to be crediting this away. Pretty much me doing this right here says I have to come to the table with less cash at closing, right? I've already submitted $20,000. So what everybody's going to do is instead of like them refunding that and then asking for it back again, we're just going to apply that to the cash due at closing. Makes complete sense, but sometimes we get confused as to how to do that within QuickBooks. So I just established that, ahead of time. Whenever it cashes, record that transaction. It sits as an other asset. It's currently still your money. You just don't have control over it. It's not in your checking account anymore, but it's sitting there waiting for the purchase to happen. As soon as we purchase, we want that to go to zero. Let's record the purchase. All right, so this is always going to be a journal entry, even if you have a bank transaction coming through. We still want to record a journal entry. Okay, the reason for that is I think that purchases and sales and refinances are really important. They often have a lot of complexity. They have a lot of ins and outs, and I think it's very beneficial to be able to come back to a journal entry and understand where everything went. And all we're going to do is we're going to work down this entire thing here. So first is contract sales price. Now, we don't know necessarily from the HUD what the market value of this property is, and it doesn't matter. For our purposes, we're going to put simply the book value on our property. That means the entire $650,000, in this case, is going to go toward my assets. Now, we kind of want to instinctively put that toward building, right? Unfortunately, the entire thing probably in almost every case wouldn't go toward building, right? We'd probably split that up between land and building. Now, the exact way that you do that is something that you're going to discuss with your tax professional. Typically, a good way to do it would be to take your current tax assessment and see the proration on tax or on land versus building there and use the same thing here. If you're not sure and you kind of like, well, I don't know what the split's going to be and I have no idea how I'm going to calculate it, here's a little trick. Just put 0 in land for now and put the entire building as a debit. Okay, and then just make sure when you talk with your tax professional before you file taxes on this whole thing, understand, move this around a little bit. Make this 25,000 and then make this 625. Whatever it is, you're going to talk through with your tax professional and figure that out. But if you're not sure, just put 0. But the fact that it shows up as 0 gives us a kind of hint that we got to come back to it later. We're going to indicate our class here, 122 Buffalo Street. All right, so the first thing I do is $650. Now I've got these settlement charges, $6,400. Let's scroll down and see what all these are. Now, this is a cash deal. That means there's no financing. That means that pretty much everything that's associated with that $6,400 is going to be a closing cost, and we're going to typically put those on our basis, meaning put them on our balance sheet in the closing cost subcategory. So we got $3,750 in title insurance, another owner's policy, another one here. Okay, so the entire stuff, these government fees, the survey, everything totals at $6,400. Now I could lay all of these out into individual lines. I sometimes do that if I want to really make sure I don't make a mistake. But in this one, it's pretty simple. We kind of see everything flowing through here. So we can take one single line and indicate closing costs, right? And we can do $6,400. And then in your description, go ahead and put closing costs. Again, I'm leaving business blank for now. We're going to cover that in Module 6. All right, so I got my $6,400 there. Then I have this other stuff. This is other stuff that I owe because maybe the seller paid it, but because of the dates, I actually owe it. So city taxes, this is going to be property taxes. Now, a lot of people will look at that and say, well, isn't that a closing cost? Well, it's specifically taxes, or if it's specifically debt service or insurance or something like that, we should record it to the cost of goods sold category through which we're gonna track everything. Okay, we might as well get that deduction if we can, and we certainly can here. So 225.45, we're gonna debit that because we're increasing it. And a little trick here is that most everything on this top line here, we're debiting everything. All right, so this is our city tax. Next one is also county tax, so that's property taxes again. I don't find much value in separating out a separate category for county tax versus city tax. I think just having one account is good, and then in our description we can indicate county tax. All right, next is prorated rent. So this is actually rental income that it looks like I'm getting, okay, but I shouldn't have gotten the whole thing because of the dates. All right, so that is prorated rent. And then the last one here, that actually is the last one. 650, 6,400, my county taxes, 225.45. Okay, and now here's your check. Okay, I mentioned that you can check your work. Gross amount due from borrower, this 662,207.92, that should match your total debits here, and it does. The other thing that I recommended was checking and saving your work. Now, I'd love to just hit the save button here, but guess what? My debits don't equal my credits, and so QuickBooks won't let me do that. But there's a little trick that we can do. If I were to mess this up or lose internet, because we're on QuickBooks Online, I could lose this entire thing, and many times this is many, many lines long. So a little trick is just to grab any account, really any account will do. Open balance equity would be one. Just let it fill out whatever it's gonna be and just save it, okay? And what this does is if I mess it up later, I can come back and edit it again. All right, so as you're working through a journal entry and you're adding a bunch of lines, go ahead and save often, and you have to kind of trick the system by making sure you have equaling debits and credits. Now that we do, great, I can hit the garbage can, I can move on, I've saved the transaction. Okay, now let's do the rest of these. Now most of these are gonna be credits, so deposit or earnest money. So that's that deposit I have. Okay, so we're saying that I have to come to the table with $20,000 less because I have this purchase deposit account right here. Purchase deposits, $20,000. This is a deposit on hand for 122 Buffalo, excellent. And then going down, I have some taxes that they actually owe me, okay? So again, whatever the case, this is probably not the perfect example, like we would owe some and they would owe us some, but whatever the case is, we often have this. So this is 245.45, this is a negative expense. Now this happens to be the exact same as above, so who knows. And then I have county taxes below here. And this is 2245.27. And then security deposits, 2,500. So this is the case where the owner is holding security deposits for the tenants and they need to transfer those over to you. So that should be a liability account. So other current liability security deposits, you're gonna have 2,500. Now you might want to split this up by tenant, okay? That could be something where you wanna take like 1,250 for tenant one, 1,250 for tenant two, maybe. Okay, for now, let's just get it on our books. We can tweak those things later. And we actually dive deep into that in our end-to-end course, Real Estate Accounting Bootcamp, where we show balances by tenants. Okay, so we got that figured out. And now let's do a little check. Here's my total credits, 24,990.72, 24,990.72. We have a match, okay? Looks good. Here's the magic moment. The last thing we do on this is we have cash due at closing, okay? So this is telling me that I came to the table with $637,217.20 to closing. The magic moment is right here, line 11. We need to say, what account did that cash come from? If it came from a business checking account, it's the business checking account we're gonna indicate, JMB checking. If it came from you personally or from your client personally, that's gonna be more something like owner's investment, okay? Contributions, distributions. Let's say it came from the business bank account. I'm gonna pull up my JMB checking, and I love this part here. As soon as I click this, QuickBooks is gonna guess 637,217.20, and guess what? It's a perfect match with what I have here on my settlement statement for 122 Buffalo. That's my journal entry. Another tip is always attach your HUDs, okay? That way, whenever you come back to this, you're able to reference that. We have a really good, deep dive into document management in the course, Real Estate Accounting Bootcamp. I'm really big on this, being able to understand why you did what you did. Now, here's something I would want to fix. QuickBooks is kind of guessing at some of this. I'd want to just kind of clean this up and just say cash at closing for this last one. All right, then we'll save and close that. And this should give us property on our balance sheet. Okay, we have less cash, but we have property on our balance sheet. We don't have a loan in this case. All right, perfect. Now, let's talk about if we did have a loan. All right, so I got this one here. Things are gonna be a little bit different. Okay, let me drill down into this transaction and just edit it real quick. Because here I have the same purchase, but now I got some additional closing funds as well as a loan. Okay, so I wanna show you how we can record that. A lot of this is gonna stay the same. Some of it's gonna change a little bit. All right, so same exact transaction. My closing costs, that $6,400 is actually probably gonna stay the same. What I have in addition to that is I have an origination fee on the loan that I'm getting. I've got a daily interest charge, and I have a deposit into a tax and insurance escrow, but all this other stuff stayed the same. So in this case, my $6,400 can stay the same. I just have to add some stuff here, and all this is going to be interest. Now, interest, contrary to the other closing costs, is something that we are going to deduct. So this is something where I'm gonna have debt service or interest is going to be my cost of goods sold. And here I'm gonna take this $23,550 and indicate it right there. This is points or origination fee. Now you could have a separate account for origination fee. I personally don't, I just treat it all as interest. Then I have interest down here for daily interest. Now I could have combined those all together. There's my interest here of $774.25. Now another thing I should have done as I start working on this change is get rid of this cash at closing, because that's gonna completely change. So just get rid of that. I also like to move these up so that they better match the HUD. All right, so I got the $23,550, I got the $774.25. Here I have insurance and taxes that the bank is requiring me to hold in escrow. That's actually going to be an other current asset, tax and insurance escrow account. I'm gonna take the $480 plus the $2,000, $480 is going to go into T&I escrow. Okay, and that's pretty good. Let's see where I'm at if I go up. Okay, the other thing, the prorated rent's gonna stay the same, so there's my $33,000. If I have this construction escrow here, I'll explain that here as well. So basically I'm gonna be getting a loan for more than the property's worth, and they're gonna hold back $175,000 in construction escrow. All right, and that's an other asset as well. I'm gonna move that up. And I got 864, 012, 17. I have my match there. All right, now I go through my credits. Now the biggest one here, in addition to the deposit, which stays the same, and all the other stuff stays the same, is I have a new loan in the amount of $785,000. So this is going to be a conventional loan or a hard money loan or whatever it is. We could actually call it a hard money loan. It's going to be a liability, and this is going to be for $785,000. All right, and now the last thing we have to do, let's check our work. Do we have the 809,990.72? Yes. Last thing is cash at closing, again, JMB checking, and $54,021.45. Perfect match. All right, and there we have it. That's a purchase with financing. We'll save that. Now let's see how it impacts our report. Let's just go back here to our balance sheet as of 2018, and most everything's gonna stay the same. Okay, except for we have way more cash in our account because we spent less at closing. There's our construction escrow and our tax and insurance escrow. These are two new accounts, right? These are accounts that we're going to pull funds out of as we need to spend on them. Okay, so the bank's gonna pay our taxes and insurance on our behalf, and as we incur construction draws, which we're gonna handle in Module 3, we're gonna draw upon that $175,000 construction budget. Building and closing costs didn't change at all, but I do have my big $785,000 loan here. Now notice net income went down a lot more. That's because I incurred a lot more of those expenses that often come with a finance deal, big time interest, okay, and my property taxes there as well. So those origination fees, all that interest, we're calculating that. We're typically deducting that in the year it's incurred. You might want to put that in your basis as well. It's a discussion for you to have with your tax professional. Generally though, we are allowed to deduct it, so we should. All right, let's talk about balance sheet versus cost of goods sold. So this goes on to the last thing we're going to talk about with purchasing property. And this is, how do we know if the purchase should go on the balance sheet or the P&L? Everything I've demonstrated with you so far, we put the property on the balance sheet, which in most cases makes a lot of sense. It's an asset for us. It's inventory for us, even if we're flipping. All right. Different approach for flips versus long-term rentals. Okay. So what I want to talk about here is, well, in theory, it should probably go on our balance sheet no matter what. Oftentimes, a flipper, somebody who flips properties, wants to see it on a P&L. So I want to show you exactly how we can do that. Let's start with our actual chart of accounts. First of all, I have these inventory items. So even if we are tracking it as a flip, I'm typically putting it under other current assets as opposed to fixed assets because it's more current. It's something that I'm probably going to sell relatively quickly. So I like to have these accounts separated out for flips. So buying cost, debt service, holding cost, purchase price right here. Okay, fine. We have those ready to go. But I also will typically have cost of goods sold for my flip categories. So in my experience, both as a flipper myself and as somebody who has done bookkeeping for flippers, is we often want to see everything in a profit and loss format. And to do that throughout the flip, we might want to see that purchase price and a lot of the associated costs with it on a profit and loss. Now we might transfer that about. I'm going to show you that in future modules, and we dive deep into that in the Real Estate Accounting Bootcamp. But we have to understand that sometimes we want it in cost of goods sold versus in the balance sheet. So I want to show you what that means. The good thing is, it's not changing that much. If we go into that exact same journal entry, which I can get to by just drilling down, you notice that I'm getting to most of my transactions by drilling down. That's my favorite way of doing it. Let's get to this transaction, and what we're going to do is, first of all, with a flip, you typically don't need to track land because we're not depreciating anything anyway. So I can get rid of that. And instead of putting it toward building here, I have a flip cost of goods sold category for purchase price. Okay, and that is a cost of goods sold. So here's my purchase price I'm going to do. Now closing costs, again, if I'm not tracking the actual purchase on my balance sheet, I'm certainly not going to track the closing costs on my balance sheet. These are going to be something like buying costs. Now your business or your client, if you're doing this as a bookkeeper, it might have different categories for these. It's really whatever the categories are that they do to analyze, is this a good property for me, right? It's usually like sales price minus purchase price minus buying costs minus holding costs minus debt service, right? And that's what I'm gonna do. I'm gonna actually move some of these as well. So interest, I have a specific debt service account for my flips, and I actually do it as other expense. I'm gonna show you why further down the road here. But I have a debt service account. And let's see, property taxes is going to be holding costs. So I'm typically treating all my utilities, my taxes, my insurance as holding costs. Okay. Oh, that's flips in progress. I don't want that. I want cost of goods sold. There we go, right there. Tax and insurance escrow is going to stay the same. Property taxes is holding costs. Rental income, I probably wouldn't have rental income if I'm flipping it, but that would stay the same. Construction escrow, the purchase deposit, all that stays the same. Just these little categories here, we're going to put them over toward, in this case, holding costs. That looks good. Now, one cool thing about this, one reason we might want to do this is to make use of the projects portal, okay? And I'm going to do that here. I'm going to do 122 Buffalo flip. I wonder if I can make that a project right off the start. I don't think I can. So what I'll do is I'll do it and come back to it real quick. Actually, no, I can't. Okay, so I'm just going to save this as it is and X out of it. And what this does, if I go to my balance sheet here and go to my net income, big time negative, right? Go to this right here. And now it shows up a little bit more like a flip would, where I have my purchase price, my buying costs, my holding costs. It looks like I have some old stuff in here too that I didn't move over yet. And this is a benefit to us. Where do I have that? There, this property tax. This is a benefit for those of us who want to see our actuals like we do our analysis. Okay, now I'm going to show you in Module 3 how we can then move this back over to the balance sheet, because this shows a big negative net income. And if we're moving through the year with holding this giant negative net income, we know this property's worth something and we're going to sell it. And therefore, like, to see our balance sheet negatively impacted like that is probably not useful to us as business owners. So we want to know how we can move things back and forth, and I will show you that in future modules. But I just want you to understand that if you're flipping, if you're doing long-term rentals, whatever the case is, it might go to the balance sheet, it might go to the P&L. Okay, there's not necessarily a right way when it comes to operating the business. It's about what the business owner wants to see. When it comes to taxes, absolutely there is. In almost every case for taxes, the purchase of property is going to be on our balance sheet. That's why we have to understand how to move it over to there if we put it under cost of goods sold at any point in time. I will show you that in future modules. But what I want you to take away from this is that the purchase of property is not super complex. Understand journal entries, be really confident in how debits and credits work. Follow the HUD to a T. Understand how to translate things from debits to credits from there as well. And then lastly, understand that depending on the situation, depending on the purchase, you might go to the cost of goods sold, you might go to the balance sheet. Understand in which case you would, and then we'll get into, as we move through, how to potentially move things back and forth between them. Let me know your questions. Let me know what else you need to hear here, and check out the other modules we have associated with this entire setup here, this entire sequence. Also check out Real Estate Accounting Bootcamp. We go way more in depth here, as well as I'm along for the ride with you, answering your questions through the community and within the course itself. We'll see you on the next video.